Hello everyone, I hope you're doing well. Thank you so much for joining me. I'm very excited about this video because today I want to talk to you about something that is extremely important for anybody who wants to improve their financial health. We're going to talk about 5 key facts that you probably don't know about IRAs, individual retirement accounts, and how these 5 facts that I'm about to share with you will help you improve your finances. By the way, if you're not yet subscribed to my channel, please go ahead and hit that subscribe button and make sure that you ring the bell to enable notifications. So the first key fact that you may not be aware of is that even if you don't qualify for a tax-deductible contribution, you can still have an IRA. Here's how it works. If you're covered by a retirement savings plan at work, for example, if you have a 401k or maybe a 403b, and your adjusted gross income exceeds applicable income limits, your contribution to a traditional IRA most likely will not be tax deductible, unfortunately. But do not let that discourage you. Getting a tax deduction is not the only benefit of having an IRA. Non-deductible IRA contributions still offer the potential for your money and your earnings to grow completely tax-free until the time of the withdrawal. In addition to that, you also have the option of converting those non-deductible contributions to a Roth IRA, which we will discuss later in this video. The second point that I want to share with you is that a non-working spouse can open and can contribute to an IRA. Effectively, this will allow your non-wage earning spouse to save for a retirement too, while taking advantage of a deduction. This option is really great for those of you who file a joint tax return with your spouses. If your spouse is working and together you file a joint federal income tax return, the non-working spouse can open and contribute to their own traditional or Roth IRA if they choose to open a Roth IRA. If you're wondering how much a non-working spouse can contribute, he or she can contribute as much to the IRA as the wage earner in the family. Definitely don't miss out on this opportunity because it can provide really good tax benefits. The annual contribution, by the way, the annual contribution limit does change every single year. This year it is $6,500 or $7,500 if you're age 50 or older. As with the majority of tax breaks, there are thresholds, so keep in mind that the amount of your combined contributions cannot be more than the taxable income that you report on your joint tax return that year. Now let's chat about the third fact that will help you save more. Even if you exceed the income limits, you might still be able to have a Roth IRA. A very good thing about Roth IRAs is that these accounts offer great ways to diversify your retirement funds. Based on Roth IRA rules, distributions are available anytime without taxes or penalties. So you can still establish a Roth IRA by converting a traditional IRA, regardless of your income level at any point in time. Even if you don't have a traditional IRA, by the way, do not be discouraged too. It is possible to open a traditional IRA and then make non-deductible contributions into that account. Later on, you can convert a traditional IRA into a Roth IRA. In this scenario, I want you to know that the only tax that you will owe to the IRS is the tax on the account earnings, if any, between the time of the contribution and the conversion. Now on to the fourth key fact that I want you to know about IRA accounts. Hopefully you do find this video helpful. Alimony does not count as earned income to the recipient. In real life, it means that alimony is no longer considered taxable income to the recipient. And the source of IRA contributions must be taxable earned income. Alimony agreements entered into prior to December 31st, 2018 are grandfathered in. They're tax deductible for the person who is making the payments, and they do count as income to the recipients. Anything that is made after 2018, any agreements that were reached after 2018 do not follow these rules, so they're not considered to be income for tax purposes. It is the date of the agreement that decides the taxation of the alimony payment, not the year of receipt of the funds. The fifth important fact that I want to share with you is useful for those of you who are self-employed, who are freelancers, or gig workers. If you are self-employed or have income from freelancing, you can open a simplified employee pension plan, more commonly known as a SEP IRA. Even if you have a full-time job as an employee and if you earn money freelancing or running a small business on the side, you could take advantage of this opportunity, of this potential tax break that an SEP IRA offers. This type of an IRA is very similar to a traditional IRA account where contributions may be tax deductible, but the SEP IRA has a much higher contribution limit. The amount that you, as the employer, can put in varies based on your earned income. Those of you who are self-employed can contribute up to the lesser of 25% of your compensation or $66,000 this year. And this amount may change going forward once it is indexed for inflation. All right, I know that I just shared a ton of information with you. Hopefully this video is helpful. If that is the case, please go ahead and subscribe to my channel, comment below, let me know if you have any questions. And of course, I appreciate every single subscriber and viewer, so thank you very much for joining me. Remember to ring the bell so that you don't miss my future videos and come back here for more content. Thank you for watching, and I will see you next time. Bye for now.